Hello, my name is Leeson. My name will be best remembered for my part in the collapse of Barings Bank in 1995. It's not something that I'm proud of, but it did happen. And I think you can learn as much from your mistakes as you can from your successes. Rest assured, if you're trading the financial markets, I've made all of the mistakes that you are likely to make during your trading career. During my daily business, I encounter a large number of retail traders who are still making mistakes when they trade the markets. Far too often, they are simple, they are easily avoided, but they are far too often repeated. And that, unfortunately, is why retail traders continue to lose money. You can summarize these in 3 or 4 different areas, which I'm going to discuss with you now. The first one of those is the amount of money that you risk on each trade. It should be a small percentage of your account balance. I'm often asked how much money I risk on each trade. It's irrelevant. It really comes down to the percentage of your account that you are risking at any one time. So that's a per trade limit and that's a per account limit. So if you have one trade, the amount of money that you should be risking in terms of your account balance is between 1 and 2%. If you're a more experienced trader, you could maybe bring that up to 3 and possibly as much as 5% of your account balance. This will instill a discipline in you that makes sure that your trading is kept safe, that you are managing your risk as effectively as you can, and you are always in control of the amount of money that you have risked to the market. The overall total, if you're then running 2 or 3 positions, will run somewhere between 3 and 8% of your account balance. This will ensure that you don't blow up. Unfortunately, far too many retail traders blow up their account by oversizing, by not managing the risk that they are allowing on their account. If you start with this basic discipline from making sure that you're not risking too much money to the market at any one time, it will make sure that you avoid some of those simple mistakes like missizing, overtrading, and taking on too much risk. Those are the things that lead to most retail traders ending their accounts fairly quickly because they are risking too much money at one time. Unfortunately, I think with human behavior, it is far too often that we see people looking for easy money, generating big returns off of quite small accounts. It's not going to happen. The first thing that you need to do is make sure that you instill that basic discipline into your trading. The second thing that you see a lot of retail traders doing is trying to cover too many markets. I don't know how many markets there are, but the only markets that I look at are 3 that I am going to actively trade. I don't want to be looking at 25, 26 different markets, trying to work out which one's going to break out, which one has the most perfect setup. It really is just about specializing in those 3 markets that I'm actively going to do business in or to trade in. So for me, that's the Dow, that's the DAX, and that's gold. Now, why do I choose those 3 markets? Why am I not trading currencies? I need a market that's volatile, that's going to move. Because if you don't have price action and if you don't have that volatility, you're not going to make any money. Doesn't matter how good you are, you need a certain amount of volatility to ensure that you have that opportunity to make money. Unfortunately, with volatility comes risk, and that's why it's so important that you have that discipline and that you are managing your risk as effectively as you possibly can. Breakouts do happen, the perfect setup do happen, but you are going to find those far easier if you specialize in a smaller number of markets. Unfortunately, the third thing when people are looking at these broad range of markets is that they try to be as active as they can continually throughout the day. And what that often results in is that people force trades. They think that they need to be doing something, and you don't. As I've already mentioned, you need volatility, you need price action, and there are certain times of the day that you can guarantee that. Be that the opening of the European markets early in the morning, or the ringing of the bell as the markets open in New York in the afternoon. During those periods, you can guarantee movement. So that's what I focus on. I don't want to be sat at a screen for 12 or 13 hours a day, waiting for a market to move, trying to work out which one of those markets is going to break out. I know when the market's going to move, and I focus on that particular period of the day. So if you would like to avoid making some of these mistakes, please follow me at bullandbearcap.com, and I can show you the way that I trade the financial markets. Thank you.